Good afternoon, and welcome to the webinar hosted by the Investor Responsibility Research Center Institute and Tapestry Networks on our latest research report, Buybacks and the Board, Director Perspectives on the Share Repurchase Revolution. Our agenda this afternoon is introductions, a review of the methodology, report highlights, report details, the IRRC Institute's perspective on the research findings, and then we'll take your questions. In terms of the logistics for the webinar, all of the attendees are in listen-only mode, but we do encourage your questions. Throughout the presentation, feel free to type into your control panel the question function, any questions you may have. We will read them aloud following the presentation and answer them. This webinar is being recorded, and you will receive an email with a link to a replay. This report and all others are available on the IRRC Institute website. They're at the URL there, www.irrcinstitute.org. We encourage you to share information on social media about the report. You can find us on Twitter at IRRC Research and at Tapestry Network. If you have any audio issues during the webinar, please feel free to contact GoToWebinar at 1-800-263-6317. We have two speakers today. The first is Richard Fields, and Richard is the principal at Tapestry Networks, and he is the principal author of the report. He's an attorney and previously worked at Ropes & Gray and Latham Watkins. Richard leads a number of corporate governance initiatives, including the Lead Director Network, the Compensation Committee Leadership Network, the Audit Committee Leadership Network for North America, and the Southeast, Southwest, and West Audit Committee Networks. Our second speaker today is John Lekumnick, and he has served as Executive Director of the IRC Institute since it was founded. With the board, he's led the organization to become a leading source of objective academic and practitioner research on a wide array of investment issues. John's got decades of experience as an institutional investor, including time as the investment advisor to the New York City pension funds. John also is the author of the new book, What They Do With Your Money, published by Yale University Press. Just a few words on the IRC Institute if you're not familiar with the organization. It was established in 2005, and essentially what the Institute does is it provides funds for objective and unbiased research on a whole host of issues that are interest to investors and other stakeholders. Everything from the capital markets to environmental, social, and governance issues to executive compensation, just a wide range of issues. We also sponsor an annual research award with two $10,000 awards. The research awards are open to both academic and practitioner research, and the deadline is coming up soon for submitting the research. That would be October 7th, and there's information on the website about that. There are more than 40 research reports available on the website at no charge, and we, of course, encourage you to go look at our previous work as well. And with that, I'll turn the presentation over to Richard, and he'll talk about Tapestry as well as do a deep dive on the research. Richard?
Thanks very much, Kelly. Just a few words about Tapestry, which is a small for-profit company founded in 2002. In essence, we help non-executive and executive leaders of large public companies become more competent and confident governing and leading those companies. Most of our work, and where most of you probably heard of us, is in leading roughly 15 peer networks for different leaders based on geography and company size, including lead directors, compensation committee chairs, and audit committee chairs. This report, as you can see in the next slide, builds on those relationships that we've built with directors. In essence, this is a report of 44 director interviews who collectively serve on the boards of 95 publicly traded U.S. companies with an aggregate market cap of $2.7 trillion and aggregate annual revenue of $1.4 trillion. The report, which, as Kelly noted, you can download on either the IRRCI or Tapestry website, focuses on the interviews with directors, including unattributed italicized quotations, like some that you'll see in the report and the slides here, but it is also informed by broader research related to share repurchases. The data set is explained more fully in the report, but as you can see briefly on this slide, it includes a broad range of industry sectors and company size, and as the directors noted, also a broad range of company stages in different life cycles as indicated below. Why don't we talk a little bit about what the report is and isn't. As you can see on the next slide, what we asked directors about is the board's involvement in buyback decisions. When do repurchase programs make sense? When is a repurchase program successful? And do the criticisms of buyback programs have any merit? The report is not, as you can see in the next slide, about whether buybacks are good or bad. If you're looking for a full-throated criticism or defense of buybacks, look elsewhere. There are more than enough reports out there. This really is intended to report how directors think about buybacks, not about the inherent goodness or badness of them. Some highlights here. 1, buybacks are at historically significant levels. 2, macroeconomic factors make buybacks particularly attractive right now. 3, there are 4 distinct reasons that directors gave that for buying back shares. The first is to return capital. The second is to invest in the company. The third is to offset dilution. And finally, the fourth is to alter the capital structure. Perhaps unsurprisingly, most directors do not believe buybacks jeopardize growth or unjustly enrich executives. And finally, disclosure about buyback decision-making is rare. Let's talk about the historical context. As you can see on this slide, buyback activity and broader capital return, including dividend activity, is at a significant, historically significant level. The $166.3 billion spent on repurchases in the first quarter of 2016 marked a post-financial crisis high. In the last 3 years, over $1.5 trillion has been spent by S&P 500 companies on buying back their own shares, and that's not just the top S&P 500 companies. At least 370 of the 500 in the S&P 500 have bought back shares in each of the last 9 quarters. On the next slide, you can see that there are some macroeconomic trends that the directors said make it easier for them to support buybacks of their companies. And as we'll talk about in a few minutes, most of the analysis is very company specific, evaluating what the options are for capital at the company, where the company is at in its life cycle, et cetera. But a few things affected the majority of companies, and directors identified 5 particular trends to look out for. The first is that companies have a lot of cash. According to EY, non-financial S&P 500 companies had roughly $1.8 trillion in cash holdings in the fourth quarter of 2015, more than double what was on hand in 2009. Second, despite all of that cash, there aren't very many good growth opportunities, directors said. Many expect the low growth environment to continue both in the U.S. and abroad, and without growth opportunities, there is even more pressure to do something with that cash, particularly to transfer it to shareholders. Third, the low interest rate environment was cited by a number of directors as a reason for buybacks, primarily for 2 reasons. First, the low interest rates mean that all those cash holdings are not generating very much meaningful revenue for companies. Second, and more importantly, most directors believe that if a good growth opportunity presents itself, the company will find it easy to get attractive financing terms to take advantage of the opportunity, minimizing the need to keep a lot of dry powder on hand. Tax policy plays an important role with a specific type of buyback, the debt-funded buyback or leveraged recap. As all of you know, tax policy has caused a number of companies to keep earnings offshore. And because creditors know that those unrepatriated earnings could be tapped at any time, corporations can engage in almost costless borrowing. As an example, Apple borrowed $17 billion part to fund a buyback program at an after-tax cost of 10 basis points lower than 10-year treasuries. And finally, and perhaps the area that's been most well covered in the press so far, a number of directors said that the number and power of short-term investors, the activists who seek buybacks, is affecting decision-making. As noted in the report, PwC found that companies targeted by activists nearly double the amount of operating cash flow devoted to capital return in the year after an activist announces a purchase. Those are the macroeconomic factors to what happens at a given company evaluating a buyback. The first question we had was, do boards really matter in buyback decision-making? Some had the hypothesis that boards simply rubber-stamped recommendations from the C-suite. And this was clear and universal. No, boards are very involved in buyback decisions and take them incredibly seriously. framed differently by each director, essentially they all said that oversight of buyback activity is part of oversight of capital allocation and return, inextricably linked to the company's strategy and their most important job. How then do they get involved? Tend to evaluate buyback programs on the basis of 4 different justifications identified on the next slide. Why companies repurchase was tied to one of these 4 reasons. First, I should say that none of these reasons is terribly surprising, but what I think is newsworthy is what has been hiding in plain sight. Buyback supporters at a given company pick a reason or reasons to buy back shares, but it's not always clear which reasons or why. The company itself will evaluate the success of a buyback program based on how well it meets the objectives it set for itself. But because observers don't know the reason to evaluate the success, and observers then default into picking their own yardstick to evaluate the success of the buyback program. Much of the popular media coverage of buybacks assumes that companies are buying back shares for the second reason, to invest in the company's shares. And success is the difference in stock price on the day the shares were repurchased and the day the article is written. But that is not even the most important reason, or for some directors, a relevant reason to buy back shares. Let's look at each of these reasons in turn. The first and most common, I'd say almost universally recognized reason to buy back shares on the next slide is to return excess capital. Here, directors said the trick is determining how much capital the company needs, which requires a careful evaluation of its operational needs and investment opportunities. Directors said that at their companies, this is a robust process, typically centered around an in-depth annual review at the sort of annual strategy summit or offsite to look at the operational needs, different internal and external investment opportunities, different scenarios that might affect investment growth and operations, et cetera. And that this annual deep dive was supplemented by routine reviews throughout the year, comparing what the potential benefit of a buyback or dividend was against how the money might else be used. The next slide identifies another question inherent in this returning excess capital, which is how. Assuming the company has excess capital, it has to determine the vehicle with which to return it. A lot of the criticism of buyback programs is actually a criticism of capital return more generally. Even if we got rid of buybacks, companies could and probably still would issue regular and special dividends. So why might a company prefer a buyback to a dividend? 2 key reasons. The most important, mentioned almost by all directors, was flexibility. It is much easier to turn off or slow down a buyback program without a consequence, according to directors, than it is to reduce or cut a dividend or expected dividend growth. As directors said, dividends are essentially debt obligations, and the market will punish heavily anyone who changes their approach to dividends. The second reason was investor preference. And here, it's important to note that investors are not homogeneous and have different preferences. But the company will evaluate its own investor base, particularly the largest and most influential shareholders there, and also will evaluate whether it wants to change that base and might change its approach to capital return to help it along in changing its overall investor base. The next reason on this slide is to invest in undervalued shares. Here, the majority view was clear. The value of the company shares versus the company's perspective on its intrinsic value is an important factor when evaluating a buyback program. This might be a reason to return capital in the first place, or it might be a tiebreaker between a buyback or a dividend. The majority said that they evaluate what they think the value of the company is against the share price value and factor that delta in to their analysis of potential return of different capital allocation opportunities. But this was not a universal view, and on the next slide you'll see that a vocal minority said that buying back shares because they are undervalued is inherently flawed. This essentially came down to 2 reasons. Either the company isn't good at doing it, or companies shouldn't be in the business of doing it. evidence in support of the companies are not good at buying back undervalued shares is pretty common. You see very few companies buying when times are tough, like the immediate aftermath of the financial crisis, when on this yardstick at least, companies could have made a lot of money had they bought back at that time. And you see a number of companies buying back at what turn out to be near peak levels. When you're flush with cash and things are going well, buyback might be seen as a good way to invest, but ultimately not turn out to be such a good investment. The second argument was more philosophical in nature, that companies really shouldn't be in the business of buying stocks. Public companies are not asset managers, directors said, and investors would probably prefer to invest the money themselves and probably are better at it than companies are. The next reason is to offset dilution. And this was seen as almost on the next slide, Kelly, almost a too obvious reason to buy back shares. Of course, we don't want our shareholders to be disadvantaged by our use of equity and compensation plans or as M&A currency. A number of directors said that they begin the conversation about buying back with, well, we'll at least offset all the dilution from the past year, and then we'll figure out what to do with the rest of the excess capital. Despite the near universal appeal of offsetting dilution, there are some lingering questions about whether this is a useful way to return capital to shareholders or even a good thing. And if we have time at the end, it might be worth coming back to some issues, some questions for future research that others might pick up. The next slide identifies the last reason for buying back shares, and that is to alter capital structure. This was by far the most controversial reason to repurchase, according to the directors with whom we spoke. And the one where most directors saw the pressure of activists as having the most pernicious effect. Ultimately, most board members thought that they handled this pressure well and very rigorously scrutinized the proposal for a leverage. And as with many questions about the question about its alternatives and make a better decision. But this was the particular reason where the largest number of directors said that they could never support a buyback funded through debt issuance, and they would fight it tooth and nail on their boards. Let's turn to the criticisms of buyback programs, the two most common being that buybacks jeopardize growth and buybacks result in unjust compensation to senior executives. Perhaps unsurprisingly, the majority of directors did not believe that these criticisms had merit, but for each there were some exceptions. Let's look at both the majority and minority perspectives. Most directors do not think that buybacks jeopardize growth because directors said companies have an inherent growth bias, and if anything, are often unjustly optimistic about returns. Just earlier today, a director said, I've never met a CEO who wasn't more bullish on the share price than everyone else. And whether due to a particular desire to grow the company or build a legacy or an honest and ultimately objectively true belief that there will be more growth if they invest, directors said that they often found themselves needing to push back against growth projections to make sure that the company wasn't chasing uneconomic growth. But as you can see on this slide, there were a number of directors, a minority, but a meaningful minority, that said sometimes buybacks have affected growth. As you can see, the first quotation on this slide, I have seen cases when we've done buybacks at the expense of other options that made sense. Some directors did not have that experience, but did notice or were concerned by the possibility that the pressure for short-term performance, the risk aversion of senior executives, and investor buyback preferences could distort decision-making and result in an uneconomic choice. The second criticism about unjust compensation was a little bit easier to address. As you can see in the next slide, the vast majority of directors said that this was not a real issue for two reasons. First is because compensation targets are set well in advance of compensation payouts. Virtually everyone I spoke with who sat on a compensation committee said that the company projects the anticipated buyback and the effect it would have on any compensation metrics like EPS and sets targets accordingly. And then when it comes time to determine the payout, it looks back at the projections, and if they are not accurate, it adjusts to make sure that there was no unjust enrichment. And unjust here is a loaded term, but to be clear, it simply means not paying for a type of growth that the company didn't want to incentivize the CEO to create. People can argue about whether metrics like EPS make sense or whether executives deserve to be paid at today's market levels, but the directors that we spoke with said that buybacks are not used either intentionally or unintentionally to financially engineer senior executives' pay to higher levels. The interesting story here wasn't with how EPS targets and other things are adjusted. It's about who knows about it. Not everyone knew about what the company's compensation committee was doing to address the compensation implications of buybacks. This was a not common, but most common view for directors who had never served on a compensation committee. And as you might imagine, if there are some directors on the board who are unaware of how carefully the company is evaluating the compensation implications of buybacks, investors and others are also unaware. And this leads me to the final point of the report. Disclosure about buyback decision-making can be enhanced. Reuters did a study last year that found that fewer than 20 S&P 500 companies disclosed whether they excluded the effects of buybacks on the per-share metrics tied to executive compensation. And that's not even the furthest that companies could go to say a little bit more about how capital allocation alternatives are considered and for what reasons. Companies and boards spend an awful lot of time trying to make decisions right, if this research says anything, really. It's a careful analysis, debate, and deliberation throughout the year and at many board meetings. And board members go further and acknowledge that this is a core responsibility of directors today. Despite all of this, very little is disclosed. There are some exceptions that are listed in the report's appendix, but I'll just include one with a lot of text on this next slide. This was an interesting example from Johnson & Johnson from this year's proxy. On the next slide, Kelly. This was in response to a shareholder resolution seeking the company to eliminate dividends and only return capital via buybacks. And it's not the most detailed description of capital return decision-making, but it does clearly identify that the company is interested in both buybacks and dividends and those things only after internal and external investment opportunities with better returns are considered. There are ways to, in not that many words, not creating a new CD&A or even executive summary to the CD&A, say a little bit about what is important to the company and why when evaluating a buyback. And perhaps at a minimum saying what doesn't matter and being much clearer about how compensation implications are addressed. With that, I will turn it over to John for his and IRRC Institute's perspective on the research.
Thanks so much. I do appreciate it, Richard, and thank you very much for the report. We have received a lot of comments about this report, perhaps more so than almost any report other than the exec comp reports that we've done. And they've been from all sides. It's been fascinating. Who knew buybacks could attract so much heated emotion, because many of the comments were quite honestly very emotional. So I want to make it, as Richard said, very clear what this report was, but then put it into context. As Richard said, this report, while informed by the macro, really wanted to focus on, as he said, very company-specific issues. How do directors at these companies think about buybacks, because that has not been studied. Someone said, well, this report is anecdotal, and my answer would be, guilty as charged, but those anecdotes are valuable because they have not been explored before. And if you get enough anecdotes together, they form a pattern, and Richard has done a very good job of explaining the pattern. So the micro, which is this report, is corporate specific. The macro are systemic factors which may affect the rate and the economics of buybacks. So we'll get to that in a second. So on the next slide, as Richard said, the question is, how do you know if a board is doing its job around buybacks? So that's especially a question for investors. We've gone through the 4 reasons for buyback. The disclosure of the rationale is usually absent. And if the disclosure of the rationale is usually absent, the disclosure of metrics is almost always absent. And then there is the other question of, does this unjustly enrich corporate executives? And in this case, only 20 of the S&P 500 in their CD&A disclose what they do to compensate their executive compensation, to adjust their executive compensation program for their buyback program. So the obvious conclusion here is that if the boards are as diligent as Richard has indicated, it would be nice for them to tell us how diligently they do this and to give us some way to hold them accountable for their decisions. And so better disclosure of the rationale and the metrics by which they think they should be judged would be helpful. So that's on a corporate specific micro level. Next slide, please, Kelly. On a macro level, the question, and particularly in this political year, is, does the spate of buybacks hollow out the future productive capacity of corporate America? And, I don't want to trivialize this question. As Richard said, there's been $1.5 trillion of buybacks in the last 3 years. We sometimes, as investors, we're used to large numbers. We sometimes, say, okay, that I understand that number, but let me put that into the real world for you. The top 4 components of the S&P 500 are Apple, Microsoft, ExxonMobil, and Johnson & Johnson. $1.5 trillion at today's market caps are enough to take Apple, Microsoft, and ExxonMobil private, and to buy half the shares of Johnson & Johnson. So this is a big number, right? I mean, it really is a big number, and it's worth considering the macro issues. So do buybacks compromise the ability of companies to invest for the future? Directors largely, as Richard said, but not uniformly, say no. I would venture to say that the dominant macro view, as evidenced by the rhetoric in the political campaigns and in a number of academic articles, one of which was called Buyback Nation, is that a much more open question, let's put it like that. And I think there are a couple of reasons for this, and I also want to tie this back to the micro in a minute. First, we know from lots of academic research that we over-discount future cash flows. In other words, we apply too high a hurdle rate to investments in the future, which means, of course, that long payback projects such as infrastructure or basic R&D suffer the most, even though most economists would say those are the things that have the largest payback over the longer period. Immediate payback projects are therefore most favored. And to give you a direct quote, that's when you go back to the slide deck later on page 24, one of the minority directors noted there's uncertainty with all capital options except for buybacks. It is arithmetic and easy. That risk aversion is a real issue. And that is the fear that the macro side is looking at. Now, to tie this back together with the micro, I think this is can also be dealt with through a disclosure. In an earlier report that we sponsored from Mark Van Cleef and Organizational Capital, we noted that there's not a lot of good disclosure about future value creation and strategy in executive comp. They may have those metrics. They may be looking at innovation targets related to new products or services. They may be looking at their internal hurdle rates and paybacks. It's not usually disclosed. And so it's very difficult to link the micro to the macro to say whether or not an individual company is over-discounting future cash flows. They may be perfectly accurate. They may be conservative. They may be aggressive. We don't know. because they're not disclosing it. And so one of the things that would be helpful here as well, more generally, would be a disclosure of their strategy for future growth so that we could look at those macro issues by combining all the micros into the macro rather than just looking at it from a top-down perspective. With that, I'll turn it over to Kelly for questions. I thank Rich and Tapestry Networks again. I think it's a valuable contribution to the literature in terms of how directors view their job here. And Kelly, it's up to you and the listeners for whatever questions you have.
Terrific. Thanks, everyone. Couple questions we have in the queue. The first one I can answer. Will there be a recording of the program? Yes, we are recording this, and it will be posted on the IRC website by tomorrow. So you can take a listen to that and circulate it if you like. See, our next question is, how can directors judge if buybacks may not slow growth and innovation when 85% of companies disclose no metrics or related incentives that drive innovation, and 55% of the companies disclose no R&D metric targets?
I think I just mentioned that. They may be able to, it's a disclosure question. The question is, we don't know if they have those metrics internally and don't disclose them, or if they don't have them. And so that's why I just said that would be the link from the micro to the macro. If more companies would disclose those metrics, we could actually do the comparisons. Unfortunately, they don't. And so most of the studies about the overall effect of buybacks tend to be top-down studies, whereas the studies about individual corporate programs obviously are specific to that company. But it's a good question. It's the one I raised earlier, and it would be nice to have those, but we don't.
Thank you. Our next question, companies aren't hiring. Doesn't that indicate a lack of investment?
I don't think so. And in fact, one of the questions that we addressed in some of the interviews was the relationship between buybacks and capital return more generally, and both hiring and wages. And here, although it wasn't part of the report, there was some initial work done with some investors as well to say, is this something of concern? And pretty much everyone, director and investor alike, said that they view the hiring and wage discussion as being separate and not terribly closely related to the capital return, that there were different markets the company had to have an effective labor market approach, or it wouldn't succeed in the long term. It was paying what it needed to pay to be competitive in the marketplace. And if it wasn't, then that was something that should be addressed by a capital investment. And if it was, then they have to do something else with the money. So I think this is a common question. And again, it's one of those open debates that I don't think is necessarily limited to the debate about buybacks or even capital return more generally. Are we investing appropriately in our people or not? Are there macro issues with the level of investment and the supposed stagnation in the middle class? And a lot of interesting research has been done by folks like Bill Lazonic at UMass Lowell, arguing that buybacks are a big contributor to these problems that he identifies as problems. But I don't think that directors see the issues generally as terribly closely linked.
Thank you. Just as a reminder, if anyone has questions, just type your question into the question box on the control panel, and we will read it aloud and respond. Our next question in the queue, what are some areas related to buybacks that you did not research that you hope someone will research?
Well, one of the initial ones that I sort of previewed when talking about the reasons was about offsetting dilution. And again, this wasn't really an issue for most of the directors with whom I spoke, but a couple of interesting points that I think might be worthy of some additional research. One is that there is an awful lot to offset. The report mentions a metric created by a particular investment shop that noted a remarkable percentage, I think 10.8% of free cash flow was being spent on compensation of employees, primarily through equity that needed to be offset at a lot of companies. So a huge transfer of company ownership from external investors to internal employees, which may have the effect of increasing the value of those internal employees' paychecks substantially, and perhaps more than any of the other effects that buybacks might have. One of the other things that it does is it takes away one of the motivations that's a justification for providing equity compensation to employees. There's supposed to be a little bit of dilution, I think, theoretically, that the employees are supposed to overcome by creating more value for the company, to move it from something that's not yet valuable to something that's valuable. And by offsetting the dilution, you are effectively putting all those options in the money or getting more money for full value awards. So that's one issue. The second big one that I'd mention is, what do investors think about all of this? It is, as John said, unabashedly an anecdotal report offering director perspectives on buyback-related questions. It includes some public statements from investors and investor representatives, but it is not a survey of how investors think decisions. And there has the gap between what investors say about buybacks and what they ultimately want. Particularly a piece about a month ago from Reuters about the gap between what BlackRock, the largest asset manager, publicly says about the need to invest and what portfolio managers at BlackRock are looking for from portfolio companies. I think an area for future research. John, any others on your mind?
I'll leave it to the researcher to answer that question.
We have a couple more questions in the queue. The next one I'll take. Are the slides available? Yes, they will be posted on the IRC website by tomorrow. You can download them there along with the report and a replay of this webinar. The next question, what did directors say about this pervasive misconception that repurchases automatically boost share price?
Yeah, there wasn't a lot of support for an enduring effect on share price, positive or negative, from buybacks. I think that that's not one of the primary reasons. Some that support buying back shares to invest in the company think that there are other fundamental reasons that the company is undervalued, and that those reasons will result in share price accretion, not the mere fact of buying back shares. And all the justifications were almost removed from the effect, short-term or long-term, of a buyback on share price. Several noted that there was a more enduring effect from a decision to return money via dividends, and that way, all things being equal, roll through dividends and buyback. But I don't think that many, I can't say none, but I don't think that many thought there was a meaningful effect on share price from buybacks themselves.
Thank you. The next question, to what extent did the limited number of interviews bias or not bias the findings?
The bias, if there is one, I think, is in the size of the company. And you'll notice that throughout the presentation today and in the report, whenever possible, I tried to limit the data to S&P 500 companies to sort of keep this apples and apples. That's the biggest percentage of directors I spoke with serve on those company boards, and a lot of the data and research that cited focuses on those. It's a different question for smaller companies, I think. But as you can see from one of the early slides and in the appendix of the report, it's a pretty decently balanced mix of industries and company sizes within the S&P 500. It is 44 directors, which sure is not a majority by any means of public company directors in the S&P 500, but more than a handful of anecdotal there might be, but I don't think that it's broad.
I would just, two issues I think came out of this report most. Here's the lack of disclosure around this 4 reasons of metrics for success. I don't know how you bias that. I mean, that's sort of a taxonomy, and to the extent that there is bias, normally the larger companies have better disclosure. So you would think that at the most, or in most cases, the disclosure for the sample that Richard used would have better disclosure. So the fact that they don't disclose, I think I am at least willing to make the leap of faith that smaller companies do not disclose better. And so the taxonomy and the lack of disclosure, I think, are probably valid observations, even though this isn't quantitative report with statistical validity tests and t-tests and things that would stand up, quite honestly, to sort of academic tests of rigor. But I do think that the extent that in the past has correlated to better, not worse.
Thank you. Our next question, thank you for the great research. We've long endorsed clear disclosure on how capital allocation strategies align with long-term value creation. However, there also is the risk of too much disclosure when disclosing details of buybacks that may empower gamesmanship in the market or share movement. What's the appropriate balance between better transparency and mitigating perverse consequences?
I think that's
try and take this one. Go ahead, Richard.
Go ahead, John.
I was just going to say that there's always a balance, right? I mean, no one wants proprietary information or enable a reading bot to game the rest of the market. I don't think revealing your rationale for buybacks or the metrics you will use, the generalized metrics that you will use to judge success, would create that sort of, obviously if you were citing price points it would, so no one's suggesting that. Similarly, in the lack of future value creation, strategic planning, capital allocation metrics that one of the questioners brought up earlier, I don't see how that would create a gaming of the market or a disclosure of proprietary information, unless you were going to say that you were going to sink capital into this project or this service or this product. And I don't think anyone's proposing that. What we are proposing is that, or what I am proposing, I shouldn't put words in Richard's mouth, that the rationale for the buyback be disclosed, and some sort of criteria for how people could judge whether or not this is a success or not over time be disclosed. Richard, I'm sorry I cut you off there. Go ahead.
No, I think this is a great question, and in fact, for this report and for other work we do with directors, that this is a common question. Is there ever enough, and how do we balance other needs against the legitimate interests of outsiders, particularly our owners, to understand how we're making decisions? But I think there are some good examples in the report of at least getting to the point where you explain what the compensation implications will be without giving away anything proprietary, just sort of a philosophical approach. And I don't think that much color it in to the broader approach to capital allocation and return. I think John's identified a number of areas that companies and directors wouldn't want to go, but I think that there are a number of places short of that that could provide some comfort and color for those that are attempting to evaluate how the board succeeds or fails on a self-admitted core responsibility of being a director at a company.
Thank you. So that looks like that concludes our questions, and we thank you for those helpful questions, and we also thank everyone for their participation in the webinar today. Again, this webinar is recorded. It will be posted on the IRC website by tomorrow, along with this slide presentation. And if you have any questions, feel free to reach out to either Rich or John, and we'd be happy to answer those questions. So thank you for your participation, and we hope you have a wonderful afternoon. Thank you.